Alrighty, I just posted on Twitter, Peter. If you want to post that or put that back.
Okay, great. Perfect. Okay, let's get going here.
Alrighty, people are finally jumping in. All right, just waiting to let this fill up a little bit. How are you doing today, Peter?
Good. How are you?
Doing good. Just had a lot of questions. We haven't had a talk in a while here, so a lot of stuff has happened since we've last talked. AMC's had an offering. So, first question I wanted to get into with you is going to be about the offering here. A lot of people were upset about it. And, Adam Aaron said he was going to do it before he released it in a tweet. But one of the things that I wanted to get, like, what are your opinions on this dilution? I believe one of the reasons why we are doing this is because we want to raise a large amount of capital and refinance the debt as well. So that's why we went to 250 million. But I just wanted to get your thoughts here quick on the dilution.
Yeah, I mean it's a sensitive topic, but it's also like as I said, everyone has their own opinion on it. Everyone has their own questions as to what's going on, and to be honest, Adam Aaron had been sort of telegraphing something was in the works, a few days or weeks before. And if you look at the sort of slate of movies that came out of Q1, we've been warned Q1 will be disappointing. The strike previous year left to a dearth of product. And the question then is like, well, okay, if you burn through 200 million in Q1, you still have 750, 800 million lying around. Why a sudden urge for capital? And I think, if you think Q2 and Q3 and Q4 are going to be more profitable, what's the problem? Why do you need more capital now? So from that point of view, it does raise questions as to why the sudden urge to need to issue the capital now as opposed to waiting until better share price. The problem is that AMC had been, and it has been, not seller boxed yet, but it's equivalent to being, if you look at the level 2 data, you can see the spoofing going on a daily basis. So they have put it in a situation where AMC wasn't going to move much, and the question is, well, do I wait? How long do I wait to raise capital? And the other speculative point of it is, it's like, well, if you have these liquidity covenants, you have got like a short-term debt facility you're letting go to rest, but then you have negotiations with lenders coming up, and you need to prove that you have adequate capital reserves and you have liquidity margins and all that other stuff. You probably don't want to be seen burning through 20-25% of your cash holdings. So from that sense, it's like, is there going to be a great time to issue the shares if they're going to continue to suppress it? So the answer is there's no, again, this is all backseat driving after the fact. We don't know what, could he have sold them at $5 a share, $6 a share, or just get it out of the way? So this is the problem, is like, as soon as he puts an offering out, it's an open invitation to short. It's more, so you've got a guaranteed stop loss. If you short it and it doesn't go your way, that Adam Aaron is going to be selling shares somewhere close, so that you're not likely to lose a lot. So it's basically an open invitation to increase your short. And I think you were telling me earlier that the short interest in AMC has gone up significantly in the last few weeks. So there you have it. It's like you do one of these offerings. It's a double-edged sword. You're getting your capital, but you're also consigning the share price to be manipulated lower. And it's exactly what's happened. So it's like, I saw that, and I had actually, I'm pumping myself here. I have a subscription service. I'm on something called Slice, and on that service I basically put out trades that I'm doing or looking at. And I had bought AMC on that service as what do we call it, a paper trade, or what do you do it as right ahead of earnings. And of course that was on AMC was pumping, and I said, I was thinking this time could be different. It's like, Q4 was going to be a good earnings, and it just, of course, as soon as the earnings came out, they drop kicked it from 595 down to whatever, 4 and a bit. So anyway, I took a hit on that, and then of course Adam does the share offering, and I'm stopping. I stopped out of that paper trade. But it's like, it's just frustrating because I feel for everyone that's getting impatient, and because it's well, it's 3 years now, right? And it's like we haven't seen any kind of real glory in two years, and it's been like the last year it's been suppressed to high hell. I mean, just people pointing out this week that Highcroft is actually trading higher now than AMC, and the optics on that are weird. So so I guess in the end of the day, the share offering is necessary though, and I do believe it's related to debt refinancing negotiations. Uh, as I pointed out a few weeks ago, a month ago, it's like the 2026 debt issuance is the only like real negative FUD that can have any kind of impact on this. If AMC is indeed, increasing profitability by diversifying revenue sources, and a better slate of movies is coming out, and the streaming bubble has popped, and movies. I see some of the people in the geek side that not necessarily AMC investors, but they do follow movies and stuff, and they're basically arguing Dune 2 should stay in the theaters. So there's a sense is that these big tentpole movies need to be in the theaters. So end of the day, I mean, streaming versus big tent. I think the big tent still has viability, and so AMC's future is looking pretty good. But in the meantime, you have this 226 debt maturity. And my point was a month ago, before all this new issue, I said, look, in 2022, in February 2022, AMC had 500 million debt coming due. They rolled that over to 2027, and 2029. The initial plan was 2027 for a 5-year issue, but they extended to 7-year, and they did 950, and they actually issued at 300 basis points better than the debt that was maturing in 2022. Now, so if you had investors, whether who it was that were buying the ASMB bonds, but they're willing to double the amount they wanted to finance, and at a longer term at a better rate, would they have done that knowing in 2022, AMC was not as bright fundamentally as it is now, and yet they were still willing to overlook the 2026 maturity. So, from a bond perspective, I'm either thinking, like, why would I be willing to lend them money cheaper at a longer term if I thought 2026 was a doomsday? So the whole, the FUD people in the back that always talk about this stuff, they're quietly ignoring the fact that, like, common sense would dictate that if someone's willing to lend AMC $1 billion, they're obviously not concerned about what happens in 2026. So my sense was that the debt would always get rolled or refinanced, and of course it is a big chunk, and you don't want to be carrying around a 10% interest on $3 billion or whatever. So AMC should be paying down that debt if it can get it at a cheaper cost, and obviously. Where the curve is right now, AMC is able to buy back this debt significantly cheaper than par. So that's why Adam is been pinging away at it with cash. But yet to do that, he needs more cash. So the share offering is again replacing expensive debt with cheap equity, and that does dilute the shares. But the old argument is it's like given the amount of what we suspect is naked or fake shares out there, like, does dilution of real shares matter as much when there's so many fakes that have been needed to be covered? So I don't know. That's a very nebulous topic because well, tell me how many fake shares. I have no idea anymore. I mean, I had a sense in 2021. I couldn't, with all the nonsense with tokens and everything else, I have no idea, and how they're hiding it and how it's being financed, and there's so many unknowns now. I can't give you a proper answer. But you tell me that the official short interest is going up, that's great. But we all know that number is not really reliable anyway. I don't trust Ortex to have correct data anymore anyway. So, but nonetheless, to finish the topic, I think he's going to continue until he gets to 250, and that's going to keep the share price depressed. But I mean, it's so ridiculously low. Like, if you look at market cap versus cash on hand, and you consider that all the revenue that's likely to start coming in as the rest of the year unrolls, it's like I'm not trying to pump the stock here. Like, I'm tired of people accusing me of doing that shit. But I mean, it's a common sense would dictate if you don't think it's going bankrupt, this is a good price to buy it at. So. And you're seeing institutional names are not necessarily leaving. It's like people point out various funds are adding to positions, including some players that tend to be very picky about what they buy. So I don't know. End of the day, I think it's not great timing, but again, I just said the hindsight backseat driving is like, well, would there have been a better time to do the share offering? He needs the money now to get better terms for debt negotiations or pay, buy some cheap debt now as opposed to. See, the thing is, the Fed actually does start cutting, and we'll get to that. But if the Fed starts cutting, then the AMC bonds will probably rally along with the rest of the market, and those bonds will be more expensive to buy back. So because if Fed cuts rates, then a bond paying 10% was more desirable than right now when you have more alternatives. Like they said, the coupon on the AMC bonds is like 8 to 10%. So if if all rates are a new junk bond issues paying 8-9%, then AMC 10% doesn't really offer much pickup. But if junk bonds collapse in yield back to 3-4%, then AMC 10% is very valuable. So the bond will rise in value as more people want to buy the higher coupon. So there's a whole bunch of mixed messages that half the people on Twitter don't understand. So the fact of the matter is that if he wants to buy the bonds, now is the time to do it. If you believe the Fed is going to cut rates. Anyway, so that's all I got to say on that.
And the thing is, too, with that, on that topic here, it's like AMC going forward, all we've been missing at this point is content, and that all comes back here. And if you look at Q2, it looks to me a very strong release, going forward. And another thing is Megaopolis is still going to be coming out sometime this year that will be added as well. So, I mean,
yeah.
When I looked at the cash burn in Q1, it's like you can't just take a 200 million cash burn and then call it a day. You're going to have to do something, and they had to counteract that cash burn. So if he wouldn't have done anything and just let it go, everybody would have went crazy. You just lost a fourth of your reserves, and you didn't do anything about it. The stock price would have dropped, and then when he would have went to go, raise capital down the road, it would have been lower, and so now would have been the time to do it. Also, in that tweet, he literally says in the next sentence, restructuring the debt. So I fully expect that. Hold on. Apparently, I'm very quiet here. Let me push a button.
Yeah, I was gonna say I can hear you, but it's not as clear as it used to be.
Does it sound better now?
Yes, it does.
Okay, so there's this setting on the back of my mic, and it's very stupid. Sorry, okay. I apologize, everybody. Hopefully that fixed it. But so yeah, again, when it comes to AMC going forward, they expect it to be profitable 2025 and 2026 going forward. They just needed to do that one last capital raise right now, and refinancing the debt should again raise the stock price. You would now have to where like I said, AMC is not going bankrupt anytime soon. They still have tons of shares to offer. Not that I believe they even need to do it. It's not like the cash burn anytime through the rest of the year is going to eat through the reserves like Q1 was. We have nothing like that coming forward or again. So the only thing missing for AMC was content. So I agree with you right now. I'm not trying to pump it, but it's like now is like when you see Ape at 77 cents, the stock price makes no sense. You're telling me it's worth less than when we had more debt, a worse situation, worse margins across the board. You didn't have distribution before. So the way the stock is going right now, it plainly makes no sense. And one of the things I did want to point out, because this is going to be fun right when this happens. So one of the things, I want to get your opinion on this too as well here. So one of the things I think AMC did, which is why the stock dropped so hard, is I think AMC front-loaded this dilution. They did a massive portion like they did last time up front. So they dropped it hard, and now they'll let the stock kind of rebound and, dilute throughout as they get that certain price.
Yeah. As I said, it's an open message for shorts to like pile in right away. So the thing is, it's going to be a big drop right away because everyone sees that. I mean, the algos are programmed to react to that headline too. So it's not like everyone's sort of thinking about shorting more. It's like, okay, we all got to get the biggest bang right off the bat. And again, then it's like, you've got Adam Aaron in your back, not your back pocket, but you got him in your back to guard you in case it does spike up. He's going to probably that facility is going to be sitting there at the top throwing out shares. I'll give you an analogy. So I used to work at the Bank of Canada, and one of my jobs there was on the foreign exchange desk. At the time, the Bank of Canada actually intervened on the Canadian dollar market on a regular basis. Whenever the Canadian dollar would weaken by 70 or more points or strengthen by 70 or more points in a given day, we would be in there offering dollars. So what would happen would be, okay, I want to short the Canadian dollar, and I want to try and, I'll have a stop, but I don't want to leave a stop because I know the Bank of Canada will intervene 70 points away at the worst. So at the worst, I'll lose 70 points. but that's assuming I sell at the worst level of the day. But I know the Bank of Canada is going to be there to intervene to stop me from losing too much money. So it's easier to trade when you know you got someone backstopping you. And of course, that whole program blew up. I wasn't the one that designed that, by the way. I just implemented it. But the fact of the matter was that it's the same thing with having a share offering. You know that AMC sitting there offering shares in the background, so you can short it at whatever $4 and know that worst case, it's not likely to go to 4.5 because AMC is willing to sell shares there. So for the meantime, while this stupid thing is in place, and I guess sorry I shouldn't call it stupid, but while this equity offering is in place, the shorts don't have a particular panic in terms of selling. Now, the interesting question is what happens if someone wants to buy 250 million worth of AMC right away, and then the shorts are going to get screwed. So it's one of those things where they're assuming that status quo stays, where there's not a lot of demand on a given day isn't huge. But if you did have some large buyers come in, then that would ruin the whole game plan. So everything is dynamic, and as I said, and the other thing is once AMC is done, we saw this with the previous share offering. Once they're done, the share bounces back a little bit. So I just think it's a longer term perspective. I hate it because like many others, 3 years ago I got in this because I thought it was a short term play, and I thought the short term play got abbreviated unfairly in June of 2021, and I said I'll give it time, and we've given it 3 years. I do love the company though. I think it's, like I said, it's the number one entertainment company in the world for films. It's got a lot of debt because it needed the debt to get to that size, and unfortunately, maybe some of the acquisitions needed to be closed. When you do takeovers, you always acquire dead wood. But strategically speaking, if you believe in the movie theater business as a form of entertainment, and particularly as a form of a part of the American cultural dominance of the world, then you would have to believe that there's a life for theaters. And if AMC is the biggest theater chain, and it can maintain and get its debt under control, then it's a very good opportunity to be hanging around. It's certainly not a bankruptcy stock. And so, I don't see the point of selling it, even though it hasn't performed up to expectations, because longer term it will. It's, if you're willing to buy an airline stock, whatever, when COVID happened, why would you be not willing to buy a movie theater stock? So it's the same sort of principle to me. So anyway, like this debt offering is going to be annoying to deal with in terms of the price action, but you keep telling people stop looking at the daily price charts. It's just not. I'm guilty of it. I look at Hycroft every day now. So, it's a longer term process, and this equity issue is part of it. So.
Well, yeah, next year we don't have to worry about deferred rent. We don't have to worry about like you said, that credit facility that was $35 million in payments. Sorry, I'm trying to see if my mic is fixed, but yeah. So now you're taking next year. Like I said, you're gonna have the content. You don't have these side payments. You don't have to pay off your credit facility. You don't have to pay off deferred rent, which again, that's 40 million a quarter in cash burn. So that adds up quite a bit.
Yep. Absolutely.
And then, so I just want to show everybody here. You guys, here's the chart. You can look at the box office, domestic box office, see the recovery, 2020, 2.1, 2021, 4.4, 2022, 7.3, 2023, 8.9. So you're getting back to pre-pandemic levels. And Adam Aaron already said with our new margin improvements, we don't even need to hit pre-pandemic levels to get back to profitability, along with the popcorn, the Switch sales, moving into grocery stores, which he will also be doing that. I again expect new revenue streams announced very soon as well. Alrighty, so let's move on here. Okay, now I sound better. Thank God. I don't know. I had to unplug it apparently.
Yeah, there you go. Yeah, it's all good. I was gonna blame Murphy, but yeah.
probably pulled it too much here. Okay, so next thing I wanted to go here. Jamie Dimon huddles in private with Biden bigwigs as his bank faces more crimes. So one of the things that they recently just got charged with was they were able to use their Federal Reserve Bank, because it has special exemptions and laws, to make billions of trades that they didn't have to report or register. So what are your thoughts on Jamie Dimon doing that type of thing, other banks, Federal Reserve type banks doing that, and them having special little meetings to get away with this?
Well, I guess my first reaction is, like, I don't want to poo-poo it or like downplay it, but are we surprised? It's like, what else can I've said on many space calls with Not So Crazy later, and a few with you. It's like Jamie Dimon is like Teflon. It's like if you call Trump Teflon, well, Damon Dimon is even more Teflon. He can get away with the most outrageous shit, and we've seen that. It's like, what's a little like payoff here and a payoff there. I mean, the whole Virgin Islands lawsuit got quietly put away. It's like he didn't have to testify in court. So it's just more of the same. I mean, yeah, it's like, to me, this is like when Signature Bank and whatever bank we're using home loan facility loans that were meant for mortgages to basically to lend to crypto traders. It's like you're just using you're gaming the system to use facilities in a way that was not intended, and you don't until they get called out and actually censored for it, then it keeps going on. And so it's an embarrassment. So I better go down to my friends in DC, and I have no idea if Kamala Harris is going to be the next president, but obviously Jamie thinks there's a reasonable possibility she might be. So it's like, yeah, let's go remind them who how much I contribute to the Democratic. I don't. Oh yeah, it was Bill Ackerman. Was it Bill Ackerman was suggesting that Jamie Dimon should run for president? So,
Yes, Bill's dumbass. Yeah, his Bill Ackerman.
Yeah. So there's definitely political gaming going on there, and as much as we want to give Griffin shit for hedging his bets and giving money to all parties, I think Jamie does it as well. It's just not quite as obnoxious, and I think it's through the banks, how I mean, it's not as visible, but the influence is certainly there. I mean, Jamie can basically seems to get away with anything and doesn't face repercussions. So yeah, this whole, being fined for not who knows what those trades were, right? That's the thing, right? And it's like, one thing that has constantly irritated me over the last 3 years was like, oh, you're a conspiracy kook. There's no proof of this. It's like, and then of course, proof materializes, in like all the naked shorts being hidden in Europe, and South Korea actually going after HSBC and is it Paribas for naked shorting in South Korea. So don't tell me that like these odd things are not happening here and they're being hidden away, and JP Morgan doing all these trades off book is exactly one way they could possibly doing it. And don't ask me the specifics, because this is what killed me back in 2020 when I first made that post about Citadel. I wound up retracting it because I realized, look, unless I'm giving like God auditor powers and go into Citadel's offices and have absolute look to their books, there's no way you can prove any of this. And if the SEC can't do it, then how do you expect me to prove any of it? So it's problematic. I mean, there's so many exemptions, the market maker exemptions for one thing, but like the bank exemptions, or you can just be, totally dumbass like Virtue and basically pretend that, we never even had like whatever, a firewall that prevented people from looking at these accounts. That wasn't us. We just forgot to put it in. We make billions of dollars, but anyway. So I'm sorry, I'm going off topic here, but yeah, Jamie Dimon, nothing he does surprises me. Nothing JP. You get to a certain size and arrogance that at some point it gets very easy. Like, okay, I ranted last night because I was talking to a friend of mine about silver and JP Morgan's involvement in the precious metal. Now, JP Morgan hasn't always been, and I'm going to go off topic, you can drag me back, but JP Morgan hasn't been always the biggest player for bullions. They bought out Bear Stearns in 2008, 2007, 2008. So early 2008. So Bear Stearns had a huge physical precious metals group. And so JP Morgan acquired that. And having acquired that, then they became the big boy on the bullion bank street. And their involvement in things like SLV, the silver ETF, means that they can basically manipulate the market at will. And they famously got fined $920 million 2019, and 3 of their traders finally went to jail last year, I believe, for RICO charges for wire fraud and basically spoofing the silver and gold market. So if spoofing is going on in precious metals, and it has been and proven in court, You don't think that, J.P. Morgan, Citadel, Virtue, Goldman Sachs, Citibank, they're all spoofing the level twos, and you can see it in AMC, and apparently it's going on in Highcroft today. So, J.P. Morgan, they do whatever they think they can get away with, and then they just pay some money to go make it go away. And that's the biggest issue for me is it's not like I'm glad to see three guys go to jail. I'm sorry for their families, but really, it's like you need some more penalties for this kind of shit. And until bankers actually go to jail, and I mean, there's been a few here and there over the last 20 years with LIBOR and all that, but not enough. Like there's not enough of a deterrent. The banks never fit. Sure, the traders get fired, but they've socked away their bonuses if they're smart. So it's not like anyone really got hurt except for the public. So anyway, I'm going to go on a rant if I keep going. So I'll go on to the next question.
All right, no worries. It just shows that short seller data actually surges in the U.S. Back to an all-time 6-month high now. So everybody's they're starting to short. Everybody's now shorting into the S&P. What are your thoughts on that? And do you think that the Mag 7 can keep moving that forever here?
Yeah, so that was Goldman saying that. So someone pointed out today, it's like how ironic it is that Goldman is pointing to shorting out when they're the ones that are shorting some of these stocks. Nothing surprises me with Wall Street anymore, but yeah, I mean, it's like I've been saying to NVIDIA, like, I think it's a short, but do you really want to get caught running in front of a train? And when it's impossible to know when it turns. And I keep making jokes online about is Nancy sold her calls yet? So I mean, that'll be it. If you find out that Nancy Pelosi has sold her calls, if you had access to her trading system, then that you would know. Then that's the hot top. So it becomes a question. Is like at one point do the value like it just like AMC doesn't make sense to be down here. It doesn't make sense for me for advanced whatever the hell. I don't have my system up here right, but whatever the advanced microsystem devices or NVIDIA should be trading where they are, and people will make all these points about but AI and you just don't understand, this is a game changer, and it's like, yeah, I've heard these words so many different times in my career, and I can tell you 1999 I was hearing the same nonsense. So at some point the top is reached, and I do think that the increased short interest in all stocks, but particularly Magic 7, makes sense. It's just a question of how many people have been killed trying to short these things already, because fundamentally it doesn't make any sense. But that's the whole key. This market hasn't been fundamentally driven since 2008 when Bernanke decided to try his experiment. So
I do want to ask you one thing here real quick. So back onto JP Morgan for 1 second here. So we know about their short position with gold. What are your thoughts now with the price of gold surging and JP Morgan? And that might be a reason also why they had a special meeting.
That's possible. I mean, it's all conjecture. We don't know. I mean, the problem is we don't know. As I said, JP Morgan is the biggest player in the bullion bank market, but trying to identify who's got the big short in that market now is hard, because for a while, like last year, it apparently went from JP Morgan apparently they deferred their risk to Bank of America. So people were looking at Bank of America as being the big bad. And I don't know if that's true or not. It's like it's very hard to get any kind of accurate read on who's doing what in that. You can, like right now, the big topic that I'm seeing is in SLV. There's been a huge amount of shorting of SLV, which is interesting by itself. But it's like, who's doing that? Like, who would be stupid enough to be shorting SLV when this thing is just breaking through resistance and following gold, and it's trailing gold? So, is JP Morgan suffering because gold is bid, or is JP Morgan actually long gold? And like, we don't know. You can just pick out little incidents in the market. It's like, again, some wacko is trying to suppress SLV, but it's not working. And to me, SLV is a two-edged tool, because if you recall in 2021, when people were, again, there's all kinds of conjectures on who was saying what and who was pumping what, but GME had run, and then the silver lobby came out and said, hey, let's buy SLV, so let's do the silver what we did to GME, and then the Wall Street bets where people were saying, well, you're just trying to take money away from GME. It's like, well, that I can't even discount that. I did think the whole silver story was legitimate, but what happened was, instead of putting into things like PSLV, which is all pure physical ETF, you went into SLV because it has an options chain and a futures, and like, so they piled into SLV, but the problem is that the SLV is controlled by JP Morgan and all that. So when you buy SLV, you're basically forcing SLV to buy more silver, which means JP Morgan can then just borrow that silver right out and then sell it. And that's exactly what's been going on, is every time every time silver pumped, SLV would go up. People would buy SLV because they wanted a silver proxy. And then JP Morgan and other bullion banks would borrow physical from SLV and use it as the basis for shorting it. So you've seen these pumps in silver that go up $2, then drop $3, go up $4, go down $5. It's just ridiculous. And it's been going on since 2021. And I've been so frustrated. So I don't know what to make of this recent stuff in the precious metals markets. I don't understand why someone would be aggressively selling SLV when it's obviously bid, and they're are they trying to suppress it again? But this isn't the standard operandi that I'd heard, right? It's like, this is not, but there's other issues that are going on, like, so the physical stocks in the LME and the COMEX, they've been drained over the last few years. Like, there's not a lot of physical that's left in the vault. So it's like the hypothecation that's happened with the futures is such, like, I mean, if you got 100 contracts to 1,000 ounce bar, well, how is it now 200? Like you said, at some point the paper shorts to the physical is too much, and so that is the question, is like, are they had to stop that? Instead of shorting futures, they're actually shorting the SLV instead, and it's not working. So I don't know. I've got a lot of questions still going on. All I just know is that gold broke through 2,100, and the first time that happened was in December, and we saw an immediate drop right the next day, which pissed me off. But it felt like arbitrary, and that felt like it was related to Evergrande at the time, and I can't be sure of that. But this time, obviously, it's more sustained, and you're seeing it in line with moves in other commodities. Obviously, cocoa is a big talk about, but like oil is trading above $80 a barrel. WTI, Brent is even higher. So it appears to me that this is more of a fiat weakness story as opposed to a individual like pump in gold. So I think this move is sustainable in gold, and so I don't know if JP Morgan will be stupid enough to be short, but someone's trying to short SLV hard, and it's not working. So anyway, that's all I got.
No, that's good. I mean, that leads into what I was going to ask for my second question, was going to be, with gold, do you believe it's because all these fiat currencies, which we'll get into in a minute, they're all over printing, they're all over leveraged, everyone's got inflation like crazy, everyone, all these banks are in trouble everywhere, and it's like,
yeah.
I just feel like people are moving up to, realizing, we're going to end up needing more. And then you got the central banks buying gold at such a massive rate still. So I think gold's definitely, the price is here to stay. But my next question for that on gold is like, what I was going to say, do you believe it would go up from here because of all these fiat currency worries, or do you think it'd go back down? But you pretty much just answered that, so never mind.
No, it's going to go up. I mean, I'd be very surprised to see it go back below 2,000 at this point. I just saw a Market Watch story. Some advisor just said it's going to 3,000. I mean, the problem was, when I pointed out last year, I said, look, if gold breaks 2,000 and 2,100, there is absolutely nothing, like, it's a historical high. Every new high is a historical high. There's nothing. There's no resistance lines or anything to stop it from going screaming higher. So you can say 2,500, 3,000, 3,500. It's just like Bitcoin. It's like, 500,000 Bitcoin. Well, why can't gold do that? It's like, well, gold is just your old man's asset. Well, again, it's the same principle, though. It's like, now what's happened with Bitcoin is, again, it's like you want an alternative fiat. And I guess we should back up. Why did we want an alternative fiat now? Because it's been clear. It's like, probably preempting a further topic here, but, Treasury debt, U.S. debt, 34 trillion, takes a few months to get to 35 trillion. And there's no sign of any kind of fiscal restraint that's going to be applied. And there's no, I mean, forget Ukraine and Gaza and Israel funding and all this. I mean, it's just, there's one thing after another that needs to be funded. And the sense is like, oh, the Fed is, the Treasury is going to buy back some 30-year bonds, and they're going to issue short-term Treasuries to play for that. You're basically hoping that um, you're going to buy 30-year Treasuries when they're cheap, relatively speaking, because of the yields have gone up, and then you think the Fed's going to cut, so then you'll issue new 30-year debt when rates are lower. Okay, so you're basically just using the Fed to massage your debt issuance. And again, it's like you're not actually planning to pay back any of this debt. You're just planning to add more debt, but you want to do it at cheaper levels. So that you're using the Fed now as basically your means of financing your debt. And you're basically going to monetize your debt through inflation. And, it's one thing after another. It's like, and people have to sit there and go, do I believe in the faith of the not just the U.S. government, but all governments worldwide? It's like if the U.S. can do this, and every other country can do it as well. So I need something better than promises from a government. I don't trust the government, or and that was the original crypto thing. It's like, don't trust the government. So you want to pile into Bitcoin, great. And the problem is that it got a lot of momentum from institutional players that started piling in, and now it's capped out at 73 or 74,000, and maybe it's still got a lot of life to it. But in the meantime, it's overbought. So new people that are thinking about Bitcoin are saying, well, I don't want to pay at the high because I've seen what's happened before. It's dropped like 30,000. It goes from 65 to 30 or 20. So historically, I shouldn't be paying at these hype cycles. I should wait. So if crypto, especially Bitcoin, is stalled, and I've got a whole bunch of other issues with crypto regarding Tether and all that other stuff. I won't get into that, but in the meantime, if it's overbought crypto, then you want to go back to what's been a lot of underallocated asset, which is gold and silver. And it's like precious metals. The gold bugs will always point out that gold is only like less than 5% of anyone's asset, and it's like they think it's like that's ridiculously low. It should be like 10%. So it's like there's a lot of unallocated capital that could go into gold because of that. If you believe that theory that people need to be more diversified, and you don't not want to be, if you want to get out of fiat, why should it all be in crypto? Maybe it should be in other things like physical asset, like whether it be real estate or whether it be commodities. So I think that's the whole thing driving this move in not just gold but silver and other commodities. And I think it's just a reluctance to trust governments to have any kind of fiscal restraint, because they're clearly using the central bank mechanism to fund their debts and try and basically game it so that they can issue longer term debt cheaper. But there's no sense that there's no plan on ever paying it back, and that's the thing. It's like the debt will only get paid back through debt monetization, which is basically letting inflation do its thing over time. So yeah, I think if you want to hedge against inflation, you need something like gold. And that sounds so retardedly old-fashioned, but there's a reason why gold has been around for the dawn of history. It's like it's something scarce that has physical value. And again, I'm not against crypto, but it's like well, I guess we'll find out with halving and everything with Bitcoin. I don't even know enough about crypto to really talk about it comfortably. But the fact of the matter is, it's like a lot of people still don't trust crypto because it's not physical, and everything will be digital at some point. As you pointed out, the Swift is going to be launching a mechanism for handling digital currencies, and I think that's where we will go, is digital currencies. But ultimately, I think digital currency backed by something physical, is going to have more faith in it than something just purely. Again, if you have a fiat digital currency, what's the difference between that and a paper dollar? It's not. I mean, aside from it's easier to transact with, it's still going to be reliant on the government not fooling around with the numbers. You want to have something that has something backing it. So that's why I think China is stockpiling metals, because they're going to go launch a digital currency that has fully commodity-backed features to it, and that'll be a preferable alternative to whatever the U.S. is coming up with at the present time. So.
No, I mean, I agree, and I mean, that's the thing. These fiat currencies, why does anybody have any faith in these guys? They literally, the United States alone, we removed our debt ceiling, and we've done nothing but add trillions and trillions cents, and there's no stopping, there's no slowing them down. And one of the things that the ripple effect that these guys don't understand, and even our forefathers said it. If people knew what the real banking system was, we would all be marching in the streets going crazy. Because it's literally just
Jefferson. Yeah, I know that quote. I think it's Jefferson, but yeah, like the the biggest threat to democracy is not guns. It's a central bank or something like that. Yeah.
Yeah, it's ridiculous, and it's like now they're sitting there and they've been bailing each other out, doing this, printing that, and it's like eventually you start to realize, like we'll get into now, everything's fake, a lie. Everyone's cooking books. Everybody's fucked. Everybody's underwater here, and it's just to the point of ridiculousness to where it's like, okay, eventually, can the feds print enough? Well, I'll keep, because eventually, if they do that again, inflation's going to come back. So, leading into that, my next question is here. Fed Powell says don't expect interest rate cuts until more confidence on inflation. And the guy goes back and forth, back and forth. I've said many times I don't believe that they're going to be able to do rate cuts. I think there's too many problems in the United States. There's too much leverage going on. You're not going to make it easier to gain access to more capital when everybody's already extremely over leveraged. Inflation's not under control. They always say that it's at this number, then all of a sudden they revise the number and it's insanely higher than what they said. So if they go ahead and they cut, I believe you'll start seeing hyperinflation coming soon. And I think that's just all right, we feel like we're doing it now to maybe help short term, but in the long term to midterm, it's going to come back and it's going to overweigh what we did. So what are your thoughts on rate cuts this year?
Yeah. So, and I have obviously personal experience having worked at a central bank for 8 years. It's like the what people are only gradually realizing it's all a game. It's art. It's the art of the con. When Nixon took the Fed, the U.S. off the gold standard in '71, August 15, 1971, a day that lived in infamy. All you have now is the faith that your elected officials and your central bank officials will do the right thing and manage your financial system such that you will not have massive inflationary impacts allowed to persist. And so in the 70s that was tested. Inflation drove up dramatically because of the Vietnam War and the oil crisis. Shocks, the Vietnam War probably could have been forecasted in terms of its demand effects. The oil shocks could not. That was a rather abrupt turn, the creation of OPEC. So, but anyway, inflation ramped up dramatically in the 70s and early 80s. And you had a guy at the Fed named Paul Volcker. Now the guy was like kind of old and he wasn't politically motivated. He basically said, like, the right thing to do for the country is to fight this inflation, stamp it out, kill it. And to do it, we're going to have to do some really nasty things to the economy and, raise rates very quick. Well, not that quickly, but raise rates, singularly high from like 5 or 6% to, whatever, 14 or 15%. And that did its job. It showed the central bank was willing to do what it took to put inflation back into its tiny corner. Like, I don't think they had a target at the time, but inflation needed to be fought and destroyed. And, so in a sense, Volcker did that and gave the Fed some credibility, which, again, that was the early 80s. And then you had Greenspan come in, and the problem was that within 5 years of Greenspan being in, we had 1987, which was Black October. And, the reaction to Greenspan, to that crisis was, well, we've got to, well, first of all, was like the creation of the first mention of a plunge protection team, but that's getting ahead of ourselves. But so the idea was like, well, we've got to start, hand-holding the market here a little bit to make sure that they know that the Fed is on top of things and won't precipitate a worse crisis than what we already had. One of the problems with the Great Depression was the Fed actually made it worse. So the whole idea was like, well, we've learned from history, the central bank is there to try and moderate market excesses, which is not its goal. Its goal is supposed to be price moderation. But market volatility, if it's going to wreck people's lives, well, we got to do something about that. Problem is that, again, whose lives are they saving? It's not the lives of the common Joe. It's the lives of the 1% of the financial community. And to go surprise, who owns the Fed? Well, it's the 1% of the financial community. So, the ironic thing here is, and again, slightly different for me, but the Bank of Canada is a crown corporation of the government of Canada. It's not owned by private banks, but same sort of idea was like the Bank of Canada. The idea is the controlling inflation is our primary and only objective, and our credibility rests on our ability to do that. So you want to be very careful about how you protect your reputation. So what the Fed unfortunately has done since Volcker is increasingly become more intervenist in the market, and created what's called the Fed put. And so anytime there was a meltdown, whether it was the Latin American debt crisis in 94, 95, whatever, the Russian debacle, LCTM debacle, which the Fed was direct, and it wasn't bailed out by the Fed, but the Fed orchestrated the bailout amongst the private lenders who had been exposed to LCTM. So the Fed was getting more and more involved, and then of course 2008, and that was basically where Bernanke, his thesis was, well, I've got to avoid what happened in the Great Depression, and I'm going to make sure that anytime there's ever any magical disaster that the Wall Street created, I'm going to jump in and use these quantitative easing to save everyone and dump helicopter money out. And the problem was that ruined any kind of sense of restraint that, it's clear the central bank was acting to try and save the market. Okay, we appreciate that. But the longer term ramification is that what's to stop the Fed from doing this again and again and again? It's like, and Bernanke's successor, Yellen, basically did nothing to undermine Bernanke's message. So, Jay Powell's picked up the same scepter. It's like, well, him as Powell or Yellen are working together. Powell and Yellen are working together, and so all they're doing now is basically trying to recover any kind of credibility the Fed has in terms of restraining inflation. But that's why they gaslit everyone in 2021 and 2020. Inflation's not. Don't worry about inflation. There's no inflation. There is. Well, it's transitory. No. Well, it is transitory. It's maybe a little longer transitory than that. Oh, maybe I shouldn't have said it was transitory. But don't worry, we got it under control. No, they don't have it under control. They do not. They completely screwed. I'm sorry. I'm going to go into your term and start throwing expletives out. They screwed the pooch. That's the best I can do right now. But they screwed up so fucking badly. And this is the issue now. Is like everyone knows they screwed up. So now it's like, okay, we had to hike rates very aggressively to try and offset this perception that inflation's got ahead of us. Oh, we managed to see, we raised rates really high. We raised rates from 0 to 5% in the quickest pace we ever done. And but no worries, we did our job and there were no ramifications. Oh yeah, no, there were ramifications, regional bank crisis being one of them. So what's going on with commercial real estate? Well, commercial real estate was an issue. It's because all these people were buying ridiculously overpriced commercial properties using leverage and huge amounts of leverage at near zero rates because they were told the Fed was going to keep rates low for longer. So the Fed basically raising rates from 0 to 5% in a year is basically causing all these loans to come due for refinancing at much higher rates than they were. It's like, well, I can't afford to refinance this $200 million at 5% when I just last did it at 1%. It's like, what are you guys thinking? I got to default on this and walk away from it. So all of a sudden, you're seeing all these properties in the U.S. go for, property was paid $200 million in 2019. It's being sold now for $60 million. So who's going to take the losses for all this? Well, it's like the banks basically. So regional banks are hemorrhaging money on these losses that they haven't realized, and they were able to defer all this by funneling money around with the FDIC pawn shop last year. Well, the pawn shop closed in March, so there's no more FDIC pawn shop. So Powell knows this, and so people are saying now you've got to cut rates, Powell, because otherwise there's going to be a regional bank crisis. There's going to be commercial, loan real estate disaster. And Powell's saying, well, okay, I'll give you a bone. Our dot plot shows 75 basis points of cuts. And we said we'll get there, but we don't want to start cutting yet because there's other people saying, look, inflation's not going away, dude. You're not even above. It's inflation's at 3.2%. Your top of your supposed target is 3%. How can you cut rates when inflation is still above your target? Oh, you have a good point there. Yeah, we definitely care about inflation. We're not going to fight inflation. I mean, we're not going to give up our fight on inflation. We're going to keep fighting inflation. Don't worry. We're make sure that inflation will never be a problem again. And so they can't just say, yeah, we're going to cut because we need to save the financial system, because otherwise it looks like they're giving up on their their inflation fighting credibility, which is why people are sitting there looking at everything going on and saying, the Fed is full of shit. excuse my language, but the Fed is not going to be able to control inflation. Therefore, I need to buy something that's a Fed inflation hedge. So I'm going to buy crypto. Okay, well, crypto's overbought now. I'm going to go buy gold and silver and cocoa and whatever the hell else. Give me something real with my money. I don't want fiat dollars anymore. So that's basically what's happened. The Fed is sitting here on a fence. Either way, if they hike rates, they're going to cause a financial disaster. If they cut rates, they're going to cause inflation to spike up, and inflation is going to spike up anyway because, like I said, crude is back up. Now there are reasons for this, and it's not just the inflation hedge. There's also supply issues with Russia. Ukraine war is starting to have an impact. I've been telling people in my office, it's like for the last year, it's ridiculous. This Ukraine war has had no impact on markets. Well, it's starting to now. Why? Because Ukraine is starting to use drones well deep inside Russian territory to attack Russia refining and pipeline facilities, which if they get taken down, especially ones in the north, that could have long-term issues on terms of getting them back up to speed, which reduces crude supply and energy supply, which will drive up energy prices, which would cause a spike just like we saw in 2022. So the Fed is really stuck here because inflation is likely to keep going up, and they can't do anything about it because if they hike rates, they're going to cause more problems with the commercial real estate market and regional banks. But if they cut rates, that's just going to accelerate inflationary pressures again, and then they'll look like they've abandoned their inflation mandate. So this is why Powell is sitting here talking out of both sides of his mouth, and it's kind of humorous, and it's also kind of extraordinarily annoying. And again, you have to understand this entire backstory, which I just blabbed about, to understand why they got in this position. And it's basically because they abdicated their responsibility as being prudent financial stewards. And I blame Bernanke, but you can blame Greenspan, and you can blame basically just this, oh, we've got to bail out the market mentality. The plunge protection team has to sit there and make sure that no one takes a hit. No one important takes a hit. That is our financial donor. So the 1% can't take a hit. So, American public will pay for it with taxes and inflation over time. But meanwhile, our buddies in New York can't get taken too much of a hit, so we'll have to bail them out. So anyway, that's why the Fed is sitting here double talking.
Yeah, I just don't really know where they're going to go from here. Like you said, he's putting himself in a harder and harder place, and then them financially themselves are getting in a worse and worse place here too, which we'll get into while they're cooking books here. Let's get into the debt here real quick, and then this will lead into the Feds again one more time. The national debt's up to $34.6 trillion. One of the things the way that the banking system and everything's set up, one of the things that I was talking about is just going to kill a lot of these banks as well, is if they keep raising the debt, or they keep raising the rates on these treasury notes, which they're going to have to because the debt's going to get more risky. More people are, like you said, going to be leaving, going towards these other commodities, cryptos, things like that. They're going to need them to make them more attractive. Well, by doing that, you're also making the banking systems and banks themselves less and less necessary. Because most people put their money in to grow there, but you can grow your money with these T-bills and these treasury notes way faster. So a lot of people are going to start moving into theirs. I've been showing people moving to money market funds and things like that. So that's another thing that's going to come back and hit these banks and this credit loaning. Well, one of the things I showed them the other week is all these banks now are turning to private lending, and private lending's just massively skyrocketed because credit's drying up everywhere. And that's one of the things I was saying. These guys, they're all over leveraged to the point where they're going to private credit. And now private credit's, massively over leveraged. Well, you're not going to cut rates now and give them access to even more capital when it's like these guys, like I said, there's got to be a crisis this year. They got to let something happen. Otherwise, you will have, hyperinflation. And at that point, you're going to, the way people are already now, you have it to where 44% of Americans can't even make a $1,000 emergency payment. And you will have people starting asking those questions they don't want to have. So one of the things I wanted to ask you here is the Feds, what you were talking about with the bank lending program. Last month, they're supposed to be paid back $53.6 billion. And there was only $34.6 billion, which means $19 billion of those loans already were not paid back. Now, for the Feds, this is going to keep going. Obviously, you still have $132 billion worth of loans to pay back, and who knows what that number is going to be when, it defaults, maybe 50, 60 billion. What do you think the Fed's course of action is going to be to make up these loans? What do you think they're going to do?
Yeah, I know. Yeah, this again. So this whole regional bank crisis. Like again, the commercial real estate part is part of it, but the whole point of it was that they were losing deposits. So I'm going to actually have a conversation with someone today on this. The U.S. banks have typically not cared about their deposits. They have too much money coming in. They pay their retail deposits almost nothing. So they took deposits for granted, and they would basically just, and again, there's bad risk management as to how they were using those deposit funds, but they were basically saying that we'll always have people wanting to give us money, so we don't need to pay for it. And all of a sudden, when you're getting zero and then a T-bill is paying 5%, it's like, yeah, why the hell am I sitting with my bank? I don't like these guys. They treat me like shit. And I can get a much better return by going into a money market fund, and it's relatively liquid and it's government backed. So, it's no credit risk. Why the hell am I sitting in the bank? So all this money started leaving the regional banks, and for the main banks, it's a different story because again, they have their size; they're too big to fail. But it's like there's other issues, but the main thing is that the regional banks were really starting to hemorrhage deposits, and all of a sudden they realized, hey, we shouldn't have taken these guys for granted. And it got to a point where last year, of course, you had a few fail, and then you had the FDIC pawn shop created. And the issue, of course, is that the thing got arbed, and the Fed realized they were looking like a joke because by November, it's like all the new borrowing was basically arbitrage, because the rate on the loan was less than the overnight, and because of the curves inverted, so you could basically make easy coin by just borrowing from the Fed and putting it back in the Fed. So they had to basically cut that off, and they said, okay, we're going to shut this program down because it's just being used for arbitrage now, and they basically they cut the arbitrage rate for the last 2 months of it. So any loans that were taken out in the last 2 months were not arbitrage. But I don't think by that point, by January or by February, I think there weren't any new loans being created. But now, as you point out, all these loans that were taken out last year, well, the first month has come due, and I'm troubled by the fact you mentioned that 19 billion was not repaid. So why wasn't it repaid? That's an issue for the FDIC and the Fed to work out with whoever borrowed that money. But at some point, they're going to have to come to some sort of, if if 1/3 of the money coming due every month is not being repaid, that's going to be a significant problem. So the Fed's going to have to come up with some way of collecting that money, and how do they, I don't. Again, it's like, is the Treasury going to have to eat this? Is it going to have to be, taxpayers, subsidizing bank losses? And I don't have that answer, but I worry that that'll be the solution. Some sort of way of funding these losses, like just like a bank will do a loan loss provision for like a credit card debt. We lost 20%. But at least banks, when they do that, they're already charging you ridiculous rates like 20% on your credit card. So the loan losses are paid for by the higher rates. So who's paying for the loan losses on these FDIC pawn shop facility? Who's going to be like, where's the revenue to cover this? It's going to have to be taxpayer funded. So I'm not all thrilled to hear about this because, well, I'm not a U.S. citizen, but it's just like, it's typical. It's like a program jumped up at the last minute to solve a problem that should have been obvious years ahead of time, and then the mess created is not easily cleaned up, and ultimately it's like, yeah, we'll fix it over time, but in the meantime we'll have to figure out a way of, again, deferring. If they can't pay it now, we'll have to come up with some solution where they can pay later, or they maybe don't pay at all, we'll just write it off. So that's where I think things are going to go.
Peter, not to cut you off here real quick, but because you said that does go to this thing I wanted to bring up, because it proves exactly what you said. The FDIC, they had a report come out there, and they actually showed in their annual report last month that it sold 10.5 billions of securities that were tied to SVB's loans that were failed. So they took the 10.5 billion of the failed loans, sold it to an arm of the U.S. Treasuries, which means the taxpayers paid for it. And this happened again in 2008 and 2009. So I agree with you that I think that it's going to, that's what's scary, is it's going to end up being 50, 60, 70 billion if it keeps up at this rate. And we're going to end up paying that, just like we do with right here with the FDIC. They're going to sell it to an arm of the Treasury.
Yeah. So it's institutionalized, taxpayer funded. Yeah, I mean,
Bailouts. That's all it is. It's really what it is. We're bailing these guys out.
yeah. No, and this is like, it's such a broad problem. It's like, talking about draining the swamp. You don't need to drain the swamp. You need to freaking drain the swamp, like excavate 50 feet of dirt, basically take out the entire ecosystem and put a whole new, pile of dirt in there, and then start from scratch. Because like the entire system is so, yeah, I don't know. I had dreams of like, having superpower if I was in the SEC. The reality is the problem is so big. You need not even the president with full backing of both parties in Congress could adequately clean this out. You would need to basically start from scratch, and I don't think it's possible. So, yeah, I hope that like bits and pieces can be fixed, but this is a big institutional issue. It's like every time Wall Street creates a mess, and they would say, well, the Fed's created this problem. We're just exploiting the system. So, the Fed should have had a better system, and that's true. Like it's like don't hate the player, hate the game. The game sucks. So the game needs to be changed. But I hate the players too, because they're just like the Jamie Dimons of the world. They're just awful. So anyway.
Oh yeah, they're just pieces of trash at this point. So now going back to the Fed. So now that you see that, that the Feds are already 20 billion in loans back. One of the next questions I had is the Federal Reserve operated at a loss of 114 billion last year. The United States is now running at a deficit. One of the things that they just announced is today, actually, we're doing 200 million buyback in Treasury. So what we're going to have to do, that means, is since we're at a deficit, we're going to have to issue short-term Treasury notes to pay off those long-term Treasuries. And that basically adds to the deficit. What's your thoughts on that?
Yeah, so I mentioned this earlier. It's like that's exactly what this is. Just like it's like when you're getting a consolidation loan or something. You're just trying to rejig your financing. So again, it's like the long-term Treasury, because when you raise rates, the value of a long-term bond will fall. So they issued all this debt, and I looked at some of the applicable bonds they could buy with this, and it's not a big amount. You said 200 million, right? So it's almost tiny in the grand scheme of things. But long-term debt is expensive, so it's a pilot project. They're going to issue short-term. It's basically just fiddling with the curve. They're going to go buy back 200 million of long-term bond Treasury notes, and they're going to basically issue Treasury bills. So that's going to increase supply on the short end. It's probably going to push down rates on the long end. So it's basically a bit of yield curve control. But longer, it's such a small amount, it won't really have much impact. But it is, again, a test pilot, and the idea here is you want to buy back. It's like what AMC should be doing, and is it doing? It's like you're buying back your longer term debt's expensive, and you're trying to find an alternative source of financing to pay for that. In AMC's case, they're selling equity. Well, the U.S. government, Fed cannot sell equity, so they can just print dollars. So it's that's all they're doing, is they're printing dollars to buy. They're print. Okay, let me get my thoughts correct here. They are selling Treasury bills that are basically going to be funded by the market, and then they're going to use those proceeds to buy these Treasury notes, and the notes.
But they'll do it at a higher rate, though.
Yeah, exactly. So they're issuing short-term at a higher rate than the rates they're buying back. The idea is that when rates go back down, they'll issue those longer-term notes again. So you're just trying to if you do think the Fed is going to cut rates, you're basically going to be willing to wait to issue longer-term debt. And this is why I said right now the Treasury is not interested in issuing longer-term debt, because you can see what happens. They do a 30-year auction. There's no participation. No one wants to buy this crap. They need higher rates to buy it. So the Treasury's not having any luck selling 30-year notes right now. And if that's the case, they might as well stop issuing and try and buy the ones that do exist, and then wait for the Fed to cut. So I do believe the Fed is going to cut, because if nothing else, the Treasury wants them to. So, but again, it's problematic, because then the credibility is going to get written out. So it's a question is, does Janet Yellen sacrifice the Fed's credibility to save the ability of government to function? I think she will. And if it's not Yellen, it'll be who her successor is. Again, at the end of the day, I think the Fed is going to get screwed over, and it's supposed to be apolitical, but I do believe Washington is going to force the Fed to cut. And it's going to be costly, and it's going to cause the dollar to sell off more. And, so, I guess if I had one point of view, it's like I've been so frustrated because I've seen this for years, this corundum building, and I knew it was going to be a problem. So I've been bullish on precious metals and silver in particular, and Hycroft for that matter. And to see it being suppressed for 3 years when I knew this was going to be the ultimate outcome, it's like the Fed has got no alternative. They either cut rates and weaken the dollar, or they hike rates and screw the economy, and there's no easy out. And ultimately, I think the government is going to force them to cut rates. So anyway, it's inflationary. No matter what happens, inflation is going to be there. So
yeah, so no matter what, we get screwed here.
Yeah.
So.
Yeah, they can't hike rates fast enough to fight inflation, even if they do hike rates. But I don't think they will because the government can't afford higher rates, and the long end activity here is illustrative of that. So.
Yeah, it's just crazy. I was looking at the issuance of the T-bills here over the last 12 months. It's just trillions and trillions. So it's like you said, they're just trying to. But that makes more sense. You're gonna do this short term at a higher rate to pay off the long term, and then reissue the long term when you drop them.
It's like so you've got a mortgage. You can get a 30-year mortgage for 4%, or you can do a short-term bridge finance mortgage at 6% for a year or two, because you think next year that 30-year mortgage is not going to be 4%, it's going to be 3%. So you're willing to pay an extra 2% for 1 or 2 years, hoping to save 1% for 28 years. That's the logic. That's what they're trying to do.
I mean, it's just funny. It's just ping-ponging around every day. It's just crazy. But let's move on to the next thing here. So the next thing I wanted to talk about here was that the Feds, they're basically insolvent. Like we went over last year, they had a private audit done recently, and it showed that they had a loss of 116 billion, but they only had a capital of 51.3 billion. What they actually ended up doing was changing this to a new column into deferred assets. So then it actually offset, and then their liabilities. Their assets offset their liabilities. But what are your thoughts on the Feds having to cook the books and move things around to stay solvent?
Okay. So this is exactly what is going on with the regional, the U.S. banks in general. So the Fed, through their quantitative easing program, had to buy a crop load of bonds. They basically printed money and bought all these bonds, and they bought these bonds at a ridiculously they had rates at 0%, near 0%. So a 10-year Treasury, at 2% or whatever, they were buying crap loads of these bonds at really low rates. And then the Fed had to hike inflation to fight it. So you basically caused yourself a huge capital loss, because all these bonds that you bought through quantitative easing, you bought it at the most ridiculously overpriced levels, and now you bought them at overpriced levels, and rates have gone up, and now they've lost half their value. So you're going to take these big capital losses. This is exactly what the banks were doing too. Some of the worst banks were basically taking short-term deposits and buying 30-year mortgage bonds. So it's the same issue. So the banks on their accounting side have something called hold to maturity. So what happened with the regional banks is they ran out of like you've got two things. You've got a hold to maturity on your balance sheet, and you've got saleable securities, which is the other bonds that are not hold to maturity. You think you might sell them. So in a Fed's case, they don't have a hold to maturity in their balance sheet. They only had saleable securities. So everything had to get marked to market at current rates. So everything they bought would be assumed could be reversed tomorrow, because we want to reverse quantitative easing, we're going to quantitative tightening. So that means we're going to go sell those, buy back those bonds that we sold. So if we do that, then it's the same logic, but it's reverse order. So they were selling bonds, now they got to buy them back, whereas people were buying bonds and taking a loss. But if you I'm getting confused. They bought bonds. Okay, yes, they bought bonds with money. So they're sitting on the balance sheet with all these bonds, but they're being marked to market at 100%. Whereas if you had a hold to maturity, in your balance sheet, then you would not have to realize the losses on those. You would not have to market those losses. So that's exactly what this is they're basically deferring losses. So instead of having this huge loss on their balance sheet, now they're hiding some of the losses because it's, well, we're not planning on as I said, it's the deferred assets. So we're not planning on selling these bonds anytime soon. Because quite honestly, they bought so many treasuries that they're not going to be able to quantitative tightening at all within a short time period anyway. So that's again, it's like you look back in hindsight and go, what a stupid thing they did. It's like you were going to buy trillions and trillions of dollars of bonds, and you're going to all have them all marked to market because you think you're going to reverse all that right away. So they should have created a deferred asset category in the first place when they started this stupid thing back in 2008. So they didn't, though. I sit here and go, sorry, I'm getting triggered. Yesterday there was a headline saying, Fed looking into the stability of regional banks. Well, wouldn't they have started that last year when this whole stupid pawn shop got created? So I'm just sitting and wondering, why do these things always take so long, these obvious things? And again, as an ex-central banker, I know that central banks are capable of being very stupid, but it's like, this is the obvious. If you're going to buy all these bonds, why wouldn't you have created a deferred? If the banks already have hold to maturity as an asset, on their balance sheet, why wouldn't central bank have that? So anyway, that's all this is just deferring some of these losses because it's not feasible for them to sell all these bonds, even if they wanted to. They couldn't realize, they could realize all these losses, but they would never be able to quantitative tightening all the bonds that they've bought. They cannot suddenly unleash all these bonds back in the market. So it makes sense from a practical point of view, but it is hiding those losses. But those losses should never have been marked to market in the first place, given the program's aims and functionality.
Okay, thanks for explaining that. Yeah, I mean, I just feel like it's like, at what point do these guys operate at too big of a loss, or is it always just going to be at our backs of printing?
You never, like I said, unless the central bank gets totally, shut down, like in Argentina, and I don't, if that happened, I have no idea. But in the meantime, these losses are just paper; they don't matter because, again, it's like the central bank is assumed to exist in perpetuity, so it's all accounting games. Unless the central bank was shut down, in case those losses would have to be absorbed by the government. So.
Alrighty, I'm just gonna go over one more topic here. Actually, I'm getting a bad headache here. But this last one is the one thing I really wanted to get into here. I've been saying forever, the commercial real estate bubble is gonna be the thing that's gonna, start crashing these banks, killing off credit and lending, and that to me is gonna be the thing that's going to make people start to have to cover shortened positions. You have $929 billion that needs to be refinanced this year. You obviously see the economy and how much all these are defaulting, as we went over. They're going to have hundreds and hundreds of billions in losses. What are your thoughts on that?
Yeah, I mean, there's a lot of different things. Obviously, there's so many different X factors out there, and it's a real dog's breakfast. But the commercial real estate market in the U.S. is one of the biggest risks out there. And I know there's a lot of people that are saying, oh, we heard this one. Evergrande was a big problem. If you look at what happened with Evergrande, though, the Chinese government stepped in and delayed. It's like a bomb that, instead of going off right away, the Chinese, put an isolation cell around it and whatever, prevented electricity, or they shut off the thing that powered the ticker was it didn't get disabled, but it got sort of disconnected for a while. So they bought time for everyone to get out, or at least try and mitigate the damage. And the damage, it went off, but Evergrande, it was all absorbed by the Chinese system. But the absorption is now what's causing problems in China. It's like you're having the property market meltdown is still happening in China. It's like a I'm going to use a gaming term here. It's like, so there's Baldur's Gate 3, if people have played it, and Gale has this magical thing inside him. So instead of blowing up right away, he's basically just contained it. But eventually it will blow up. It's just a question of where you go, where are you in your state of your economy when that thing eventually blows up. So what happened with Evergrande is it basically was slow death, but death nonetheless. And so with real estate in the U.S., though, there's the government isn't quite as involved, right? So you can try and mitigate things, and the FDIC facility was similar to Evergrande because like they bought the market a year. It's like regional banks were going down big time last year. And this FDIC facility prevented that, but the problem wasn't going away. In fact, it's getting worse because the number of real estate deals that have to get renegotiated have increased. So and the Fed has basically said now we're not going to reopen this facility because it was being abused. But in the meantime, we're not going to cut rates. So we don't want to be aggressively cutting rates more than we've already talked about. So, whatever comes due in the next year or two, unless the Fed changes their mind and cuts aggressively soon, it's going to have ramifications. There are going to be bank losses, and Powell's acknowledged that there will be more banks that go under. And so this will be interesting because how does that affect leverage? There's all these loans, not just in real estate, but to other people. Those loans will get called. And yeah, like how much of that is in speculative plays like AMC and stuff like that. And the one thing that, again, is another interesting aspect of this in Japan. So Japan hiked rates out of negative rates for the first time in 8 years. First hiking cycle in 17 years. So Japan has been the source of huge amounts of market leverage because if you can borrow in Japan at near zero rates and then invest that in the US, well, that does is it suppresses the yen against the dollar for one thing, but what it also does is you basically have very cheap capital from from Japan, and then you basically can use that in whatever you want in other leverage plays, such as using, who knows, I mean, as simple as taking money from your dollar yen trade, taking the US proceeds, putting in the reverse repo account, getting collateral from the Fed, and then using that collateral as the basis for a loan to short AMC. So that whole dollar yen carry trade, if that finally disappears, and again, them going from negative rates to positive isn't big enough. You need the Bank of Japan to hike like 200 or 300 basis points while the Fed is cutting. Then the entire carry trade will get eliminated, and that'll be a huge deleveraging event. So that's what I'm sort of watching to see what the Japan does in regards to wage inflation. And that's not something that's likely to happen very quickly. It'll happen slowly and then with a bang. But the commercial real estate issue is probably more salient. Just because, again, if the Fed doesn't start cutting soon, those loans will start getting refinanced soon. So I'm not positive on U.S. regional banks because absent the pawn shop facility, I don't know what's going to save them. The pawn shop facility bought them time in terms of being able to park their loans there for liquidity. So they got liquidity to absorb, renegotiate some of their loans that already came due, but the size of the loans coming due now, and without any kind of liquidity facility to be able to handle that, some of these banks are not going to handle it. They're just going to go under.
Yeah, I agree. I don't know how they're going to be able to handle that big of a number.
Yeah. So, just this is my personal amusement story, but I guess it goes to like, people always wonder how could like all these smart people do so many stupid things, and a lot of it's ego, and a lot of it's just like a sense of entitlement. So I was just before we started this call, I was watching a YouTube and just a historical precedent. So when Japan attacked the U.S. in 1941, Pearl Harbor, it wasn't just carrier-based planes. They had a whole bunch of subs off the Hawaiian Islands. Now, the subs had a directive like, once Pearl Harbor's over, you guys go to the West Coast and harass the U.S., and you have these deck guns on these submarines, and they were supposed to actually start shelling U.S. facilities. None of the subs actually did that. They all went back to their bases in the Pacific and refueled and all that. But a few of them got sent back to do more of it, but they weren't on orders to shell. They were just supposed to harass shipping. But one of the commanders of one of these subs actually did go to Santa Barbara, and there's an oil refining facility north of Santa Barbara. He actually did shell it, and he fired, I don't know how many shells he fired, maybe 20 or something, and maybe like 4 or 5 actually hit something. But why did he disobey orders? He disobeyed orders because as a civilian 4 or 5 years earlier, he had been a guest at that facility inspecting it, and he was going up some stairs, and he fell off the stairs and landed on a cactus, and cactus spiked his ass. And so, of course, all the American workers at the refinery laughed their heads off at him. And so this is a Japanese, very offended, right? Very like my honor has been stained. These Americans are laughing at me. And so the whole reason he wanted to shell this facility because he felt like he'd been humiliated by these Americans, and so he wanted to take revenge on this stupid oil facility. So they're just saying this guy disobeyed direct orders from his admiral because he wanted to take out a personal grudge against this thing that had, an accident that had nothing to do with this facility, but only because the American workers laughed at him, right? So that's what I'm saying, that sometimes, like, there's all kinds of stories that go on the market, and you gotta think it's not always rational decisions that are going on. Sometimes it's pure ego, and you can point to SBF for one thing. I mean, it's like, what were you thinking, dude? And whether your mind was clouded by Adderall or not, it's like, did you like? So when I look at Jamie Dimon or stuff, like there's guys like that. At some point, they're going to overreach. Some could argue that Ken Griffin has overreached several times and got away with it, but it really comes down to a point. I'm waiting for some of this Sharon, was it Schadenfreude? I can never say the German word, Schadenfreude, whatever it is. There's going to be some karma, because a lot of these people are making decisions that aren't based on logic. They're based on like privilege and ego and just bad decision making under stress. So we'll see. Very interesting time, very interesting markets.
Yeah, it should be getting crazy here. Sorry, I'm just not feeling that good right now. I'm gonna get going here. I appreciate you jumping on there. We got a lot of topics in here today. Hopefully we can do this again soon. I didn't get to everything I wanted to get to today, but I just got a massive headache.
No worries, man. I appreciate the time, and I'm feeling sort of similar today. And again, it's snowing here, so happy to cut it short. But we can do this again sometime sooner rather than a few months from now. So.
No, yeah, I appreciate it. I'll get a hold of you here soon in a couple of days. Thanks for coming on, Peter. Have a good day.
Sounds good. Okay, bye bye.